When you give money to a business or to fund a project, either as an investor or a creditor, you're not doing this for free. Chances are you want to turn your money into more money. For a lender, it is easy to calculate his return through interest payments that justify the risk he's taking. If he agrees on his return, everyone's happy. The lender can turn their money into more money, and the business or project receives capital. But what about equity holders or investors? How do we know if we should be happy or not about a certain return? And where's that benchmark from a good and a bad return? Well, that is exactly what the capital asset pricing model helps us know. By the end of this video, you will understand what CAPM is, how it's calculated, and the potential flaws it has. So let's get into it. This is a model that helps stockholders know what return they should demand or they deserve, if you will, considering the amount of risk of a certain investment. If an investment carries higher risk, then the more return should be expected. And if it has low risk, expected return is lower too. The formula for CAPM is this one. And trust me, it's way more simple than it looks. The first item is the expected return, which is the number we want to get to. The second item is the risk-free rate. This is generally considered to be what short-term treasury bills return because they are very safe investments and extremely hard to default on their short-term payments. So this sets a floor to your expected return. In other words, you will not invest your money anywhere if the return is less than or equal to the risk-free rate. The third item in this formula is beta, and beta measures the risk of the investment you want to pursue. The higher this number is, the more return you can demand from your investment as you're taking a higher risk and vice versa. And this final item here is the expected return from the market, which after subtracting the risk-free rate, it becomes the market risk premium. You can interpret this part like this. Investors can invest their money in the debt market and earn the risk-free rate. So they need a motivation to invest in riskier assets like the equities market. This premium is exactly that. The difference between the risk-free rate and the average return from the market. The result from this is called market risk premium or equity risk premium. Now, let's imagine there is a company that has a beta of 2, so it is considerably risky. And don't worry, I'll explain this in detail in just a moment. But in the meantime, just so you understand how the formula works, let's just call it 2. We already know that the risk-free rate is 3%. And let's say the expected market return is 10%. After doing this calculation, this is our hurdle rate, meaning our minimum required return to consider for this investment. Some people are more conservative and others more bullish, so you can adjust this accordingly. But for this video, let's stick to this average. This result is the same that you will use as a discount rate for future cash flows when you want to analyze the profitability of a company's projects or the entire acquisition of a business. This is called the discounted cash flow method, and I'll leave the video in the description as it is one of those must-know metrics. Imagine the same company with a beta of 2 is pursuing a project that generates $200 each year for the next 3 years, and they ask you to invest $400. For this example, you take our previously calculated return rate of 3% and discount all those future cash flows, and we get this number. This is the value of those future cash flows today. Then we add them all together. Since present value is higher than our initial investment, it is worth pursuing as it generates value. If the company had asked you to invest $600 instead, this would make no sense, as the value of those future cash flows today is worth less than your initial investment. Now, calculating the cost of equity or the minimum return for investors is very complex. Not really getting to the number itself, because as you just saw, in a matter of seconds we calculated it with just this formula. But this complexity happens because theoretically, the business doesn't have any obligations to provide specific returns to their shareholders, as they do to their creditors. But in practice, they actually do. Otherwise, their market value will collapse as they are not generating value for their investors. However, we don't have specific numbers like the interest payments creditors will get. The other important factor for this complexity are the flaws that the CAPM formula has. Yes, the one that we just used. This formula uses a lot of assumptions for its calculation that can create an inaccurate result, and we'll go over each one, as knowing these flaws can give us leverage and keep us grounded. Let's look back at that formula and its components. Let's start with the risk-free rate. A disclaimer for this metric is that this is not literally risk-free. but short-term treasuries are so safe and highly unlikely to default on their payments that are considered risk-free asset. But beware, it's not literally zero. I wouldn't lose a lot of sleep over it. But the true risk from this item to the formula is that it assumes that the risk-free rate will remain the same throughout the whole discounting period. If you notice in our previous example, we took the cash flows from that project and we discounted them all by the same result that was calculated using a risk-free rate of 3%. If the central bank increases interest rates and so does the yield that bonds pay, the risk-free rate will go up, and therefore investors will adjust their demands accordingly and ask for higher returns. These will make projects that seemed viable and with returns higher than their cost of capital now seem overvalued and unviable under the new adjusted calculation, as its returns might fall below their cost of capital or minimum expected returns. The next flaw is the very same metric that determines what your returns will be, beta. Now, let's dig deep into what beta actually is, how it works, and why is it a flaw in this calculation. Beta basically measures how much your company moves or how volatile it is relative to the broad market. Your stock's correlation with the market is determined by how much it moves for each 1% change in the broad market. This is its beta. For example, if the stock goes up 20% when the market goes up 10%, the beta is 2. If the stock goes down 5% but the market goes down 10%, your beta is 0.5. In both these scenarios, beta is positive because it moves in the same direction as the market but with a different volatility. Beta, even though less common, can also be negative if the asset moves opposite to the market like gold. If the market goes up 10% and the stock goes down 5%, the beta is negative 0.5. If the market goes down 10% and the stock goes up 20%, its beta is negative 2. Now we have a better idea of how risky that stock with a beta of 2 in our previous example was. This means that if the market goes up, you earn twice as much, but if it crashes, you crash twice as hard. Thus, CAPM assumes you should be rewarded for bearing that risk. The reason beta is a flaw is that it only measures systematic risk. There are two concepts you need to keep in mind, as I will use them repeatedly throughout this video. Systematic risk are events that affect the overall market, like pandemics, interest rate changes, wars, oil price swings, etc. While unsystematic risk are company specific. For example, if Amazon warehouse catches fire, if Netflix subscriber counts fall, or things like CEO scandal and declining sales. In other words, under CAPM, if beta is high, you can demand a higher return, and if beta is low, the formula thinks you deserve less expected returns as it is a safe investment. But beta is not including unsystematic risks in their calculation. The reason for this goes back to how CAPM is highly influenced by the efficient market hypothesis. In short, this is a hypothesis popularized by economist Eugene Fama that claims that all available information about an asset is already priced in by the market, and therefore all stocks are already trading at their fair price. Say there is a company with promising projects that is thinking about expanding to other continent, but its CEO is about to retire. A new person will take over, so there's uncertainty. They have a lot of debt, but they generate good cash flow. This theory claims that all these highs and lows the company has are already being considered in the current price, because everyone can see those news and they have already reacted to it accordingly. So this unsystematic risk is already baked in the price. Therefore, it is very difficult to identify inefficiencies or mispricings constantly enough so that in the long run, you generate a higher return than the overall market. So while CAPM assumes a market made by rational investors who are well diversified, the efficient market theory made up by the same rational investor says all information is already efficiently priced in the stock, so all the assets that make up that market are fairly priced. Since CAPM assumes that the market is rational and that you hold a well-diversified market portfolio, in other words, you own a piece of everything, all the unsystematic risks like that Amazon warehouse fire or those subscribers Netflix is losing, even if these affects that company specifically, the impact in your portfolio is going to be minimal, like a drop in the ocean. It'll be diversified away as you own thousands of other companies that are doing just fine to make up for it. For this reason, it takes beta as the only risk you're truly exposed to and ignores all the unsystematic factors as those can be easily mitigated. Now, In theory, this market portfolio contains everything: all global stocks or private equity, real estate, basically anything that has a price is part of it. So whatever the market return is will equal the portfolio return because that portfolio is the market. Therefore, its beta is 1. In reality, of course, it is impossible to come up with this hypothetical portfolio. Even if you invest in an S&P 500 index, you're not remotely close to the market portfolio. So we use proxies like the S&P 500 or VTI ETF that cover the entire US stock market. The broader the market they cover, the more accurate CAPM can be for us. And the more narrow, like a standard portfolio of a regular investor, the less accuracy, because well diversified investors are the ones mainly exposed to systematic risks that affect the overall economy. In the real world, investors are not rational nor perfectly diversified throughout the whole market. Most investors hold individual stock portfolios, and we're mainly exposed to those unsystematic risks that CAPM ignores, as the formula only compensates for the systematic risks you take. It argues that the only way you can earn high returns on the market is by increasing your beta, and any unsystematic risk that you take will not be compensated because taking them is pointless. This is how the formula makes sure you're not compensated for this kind of risk. Say there is a car manufacturing company. For this example, the risk-free rate is 3%, and the market expected return is 8%, so your market risk premium is 5%. Also, this car manufacturing business estimates it will generate $1,000 in cash flow in the next 12 months and has a beta of 1.5. This is the required rate of return for these investors, considering the systematic risk they take by investing in this company. Now, let's use the present value formula on those $1,000 future cash flow to get to its value today. We take the $1,000 and divide it by our required rate of return. This is the fair number that investors are willing to pay today in aggregate for that future cash flow of $1,000 in order to claim 10% of it per share. Say the business has 100 outstanding shares, then investors are willing to pay $9.04 for them. Now imagine, unlike everyone else, you decide to buy this stock individually to increase your beta and earn higher returns. You analyze it and realize that it has a big unsystematic risk. The company only has one factory. If a natural event, for example, destroys the factory, the company disappears. Because you hold this stock individually and you don't have that protection that diversification offers, you demand a higher return of 20% instead of the 10.5%. So you want to pay $833 or $8.33 per share instead of $904 for this future cash flow. This gap of $71.64 or 71 cents per share is going to be your potential alpha generation. By the way, alpha is any excess on return over beta's prediction. So if a stock has a beta of 2 and the market average return is 10%, that stock should generate 20%. If it returns 25%, it has a positive alpha of 5%. However, when you go to the market with your offer of $8.33 per share, nobody will sell it to you at that discount. They're happy with paying $9.04 or $900 for the $1,000 total cash flow to equity, as that is the number that meets their expected return and aligns with the risks they're taking, which again are systematic. On the other hand, you're exposed to that factory getting destroyed by owning that stock in isolation. If these actually happen, they barely feel the impact, but you will. So essentially, the market forces you to buy at the current price of $9.04. So a year from now, assuming the company delivers their expectations, the stock will be worth $10, which is the $1,000 cash flow divided by the 100 outstanding shares. And you earn the same return as everyone else, making alpha generation difficult and only compensating you for systematic risk, not company-specific factors. In practice, of course, share prices are not worth exactly the same as a company's future expected cash flows divided by their outstanding shares, because investors are not rational and consider thousands of other things to value a business. But remember, we're assuming a rational market under CAPM theory. So if the formula tells you you need to increase your systematic risk to expect higher returns, but as we have seen, you can't do this by buying individual stocks with higher betas at lower prices because the market forces you to buy at the current price, effectively making your beta 1. How do you do this then? Well, by using leverage, borrowing money. When you use leverage, you artificially increase your initial investment using credit, being able to buy another piece of the market with that extra money, which exposes you to more of that systematic risk without using your own capital. If you invest using your own money, your beta will always be 1. But with leverage, it goes up. Let's see it clearly with an example. Say you invest $200 in the market and it returns 10%. You made $220, 10% of your money. This is as true for those $200 as it is for any other amount you invest with your own capital. If you invest $300, you made $330. If you invest $1,000, you make $1,100. In all scenarios, your beta was 1, as your return matches the market's. But let's now say that from those $200, half is yours and half is borrowed. In this case, your beta is 2. If the market moves up 10%, you move up 20%. Relative not to the entire $200, but to your own capital of $100. This is because you will get $220, then you return the $100 you borrowed, and you're left with $120. Whereas if you had used your own capital, you would have walked out with $110, the same return the market generated. In the end, you effectively made roughly 20%. I say roughly because for the simplicity of this example, we're not subtracting the interest you need to pay on the money you borrowed. This leads us to another assumption under CAPM, which is that you can borrow unlimited amounts of money at the risk-free rate to increase your beta. And I explained this further in the video of the capital market line that I highly recommend you to check as it serves as a great complement for this video. But not to go off topic, if CAPM assumes you can borrow unlimited amounts of money at the risk-free rate to increase your beta, it's claiming two things that don't apply in reality. First, you can use a beta of 5 or 10, and the result will tell you you deserve a massive return. But in the real world, no bank will lend you money at the same interest rate they lend the government because individuals are riskier for them. Therefore, the cost you pay for borrowing is higher than the reward you get for lending. And second, we face borrowing limitations. You can't walk into a bank and borrow $1,000 of your money just like that. So let's escape for a moment this hypothetical world of CAPM. This is the way you can use the knowing of these flaws as leverage for your decision making and not be fooled by just the result the formula tells you in reality. Since beta ignores unsystematic risk that most investors actually are exposed to, 4 different scenarios can happen assuming you are not a well-diversified investor. Company with low beta but high fundamental risk. In this case, CAPM is underestimating the expected returns you should get. It tells you an asset is safe, so you deserve less, but you are taking a lot of unsystematic risk. Company with high beta but fundamentally strong. In this particular case, it's important to pay more attention to CAPM because even though you have a fundamentally strong company with low unsystematic risk, if investors treat it as a growth stock, making the asset volatile, you will be affected by this volatility too, so CAPM is warning you about a real risk. Company with low beta and low fundamental risk. This is obviously a safe asset, not only relative to the market, but also the company itself is safe. Still, you need to make sure CAPM is not underestimating your expected returns. So you need to review its fundamentals and see to which degree is it safe on each dimension. To keep this simple, on a scale of 1 to 10, how safe it is. If it's a 6 out of 10 fundamentally, but a 9 out of 10 according to CAPM, CAPM is underestimating the returns that you should expect. And finally, a company with high beta and high fundamental risk. This is obviously a very risky asset from both standpoints, but still, you need to review the fundamentals besides the volatility to make sure CAPM is not underestimating anything. After listing all these flaws, I don't want you to get the wrong idea and think CAPM is useless. It can be very helpful for providing a floor of the return we should expect from an investment. Also, it is widely accepted in the finance world to calculate the hurdle rate for equity holders, serving as a benchmark for companies. So businesses usually evaluate if their projects are actually creating value for their investors by making sure its returns are above the cost of equity calculated using CAPM. Keep in mind as well, volatility risk is real. Even if fundamentals are perfectly fine in a company, this formula gives us another perspective of risk, not to be ignored. It also provides simplicity on its calculation and serves as foundation for several other formulas like the Fama-French 3-factor and 5-factor model. These are basically improved versions of CAPM created by the same economists that popularized the already cited efficient market hypothesis, where other systematic risks are also accounted for besides beta. I'll leave that video for you in the description below as well. I thank you so much for watching, and don't forget to subscribe to get more content like this. See you.